Welcome everyone. In this week's episode, we chat with Florian Heinemann and Philipp Werner, partners at Project A. Project A is a leading early-stage venture capital firm investing all over Europe with offices in Berlin and London. The firm has 1 billion in assets under management and is currently investing out of their fourth fund, which is 300 million in size. In this episode, we chat with Florian and Philipp about the origins of the firm, the 100-person in-house team they have to support portfolio companies, the recently announced venture studio, and many other topics. On to the show. Good morning, everyone. How are you, Max?
I'm very well, mate. How are you doing?
All good, all good. Very happy to have Philipp and Florian of Project A with us today. How are you guys?
Hey, guys. Very good. Thanks.
Yeah, also great on my end here.
So, Florian, Philipp, I thought we would start with a straight question, like, why do you think Project A wins deals, and what makes you guys different in this European VC ecosystem that's obviously a lot more competitive than it was when you guys started the firm? What sets you up different from the rest?
I'm happy to give it a go. So I think two things. Obviously, we're a generalist seed fund, so that doesn't set us apart. What does, though, is on the one hand that we have a very big operational team of 100 FTE, most of them based in Berlin, that actually work hands-on with the portfolio companies. So it's an extended workbench for every founder to tap into, which is quite unique. Mm-hmm. And the second is that we focus on 4 key areas in which we have strong hypotheses and like to see every deal and are quite knowledgeable about. So if you're a founder working in these 4 areas, I think there's a clear edge that we bring to the table that hopefully helps us win deals.
Which are those 4 areas?
So that's financial infrastructure, where we have, I think, a good track record, which probably we'll speak about in a minute. Then that's climate and energy. Then European resilience, which also stands out because there's not a lot of funds probably doing that in that depth. And the last one is what I tend to take care of, which is global supply chains.
Super interesting. And about this in-house venture partner model or value add model, I mean, why do this? Why do this? When did you guys start thinking about this? Does it come from the beginning of the firm? And also, how do you guys manage all of this? Because as you mentioned, Philipp, you guys do this in-house, and and you have a ton of people. I think you mentioned 100. So tell us a bit the origin story of this, and how do you guys manage this? It's something that we've tried to a much lower degree with just like 10, 15 people, and we've never been able to crack it.
Yeah, maybe I have a go here, and then Philipp, who has been part of this team also, which I think is also quite interesting that we also sometimes transition between the operational value add and the investment team, which is kind of the two teams or 2 main teams we have. That there's definitely some interchange of people, but it has been kind of part of the Project A story from the very beginning. Yeah, so it basically. Why is that? All of us, I think, have been fairly enthusiastic operators before in the startup ecosystem as founders and as operators within startup companies. And we kind of we were with Rocket Internet before. That's also probably a very elementary part of this, where the operational model was core of the DNA, and why did we start it? Because we basically saw that a lot of the startups we invested in, or we somehow had been in contact with, had similar issues and similar problems around recruiting, around tech setup, around data setup, around sales, around marketing. So you had similar kind of competencies that were needed across the various startups, and we thought if we can accelerate the build-up of internal competencies or capabilities at those startups, that would ideally help the startup to be more successful, and that was kind of the idea. So it was not about creating some kind of central hub that would centrally do stuff for the ventures, but it was really all about helping them to build those capabilities themselves. And that was kind of the core idea. And also we felt that apart from it making sense, which is I think a very good first reason, we also thought, okay, even in 2012, when the ecosystem was a lot less competitive than it is today, even then we thought, okay, what can we do to differentiate ourselves? Yeah, because often as a venture capitalist, you ask a founder or founding team, what's your differentiation? How are you different? Why do you think that is defendable, what you do? And I think venture capitalists for a long time haven't really answered that question for themselves. Yeah, and I think it's a good thing that in today's venture capital world in the US anyway, but also in Europe, I think every fund has to kind of think about what's their positioning, how do they stick out, and how is it relevant to founders. And I think that's generally a good thing because it keeps the industry innovating. And this operational model or value add model, that was kind of our attempt to do this. Yeah. So and to somehow be able to attract a certain set of founders and basically convince them that we are the best partner for them. Yeah. So that's kind of how we started it. We also evolved the model along kind of our investment kind of areas. Yeah. But we always thought about, or we always are thinking about, with a new kind of set of startups we invest in, how do the capabilities or how do the value add opportunities within those startups change over time? So we always try to adapt. So we used to invest very strongly, for example, in consumer startups. And that changed a lot towards B2B and more sales-driven organizations. So we built a sales team a few years ago. Obviously, the data team has changed a lot. Yeah. So in order to be able to support AI now or the usage of AI within organizations to a much stronger degree than it was a few years ago. Recruiting has always been an elementary kind of or a key element of the value add. So we built a fairly large recruiting team. So we always try to think about constructively what are things that matter to startups and build that capability. And that's how we've basically evolved. But it's always about what the startups or the founders ask us to do for them. So we don't bake it into a deal that they have to work with us or it's part of the equity deal or whatever. So we do always a straight equity deal, just like any other VC would do. And then we open up the menu basically of possibilities to work with us. And if startups want to do that, they can, but they're not obliged to do it, and we don't expect it from them. It's just about what they want. We offer it to them as an optionality, and if they want to work with us, that's fine. And if they don't, that's also great. Yeah.
And maybe
Florian,
expanding a little on how we manage this, because you asked, Jaime. So in practice, operationally, that means that whenever we invest in a given company, we do an operational kickoff with them afterwards. So basically, the partner who led the deal is there, and then a dedicated venture development manager, which is essentially a key account person from the operational team to the founder. And we try to understand, based on our investment hypothesis, but also obviously a lot from the founder, where they think help could be needed in the months to come. And then we do specific onboardings with these teams, right? So if a company, for example, has 50 open roles at the point we invest, then we obviously do a dedicated kickoff with our talent acquisition team. If they know that they have to build out their data competencies, then we do a dedicated kickoff with our data team, just to get to know each other, understand what capabilities we can assist with, what not. And then the founders obviously either engage into a working relationship with that team or they don't. And oftentimes we see that we're actually supporting early on to a small extent with things that are just very urgent and the founders really need it. And then oftentimes we don't really support for a long time. And then founders come back when they have specific challenges that they're facing. That can be that they hit product market fit and now they need to scale on many ends of their organization. It can be that they've lost someone who basically left the team and we need to jump in on an interim basis while they find someone. So it's a lot of different situations that pop up along the collaboration over the years where they basically knock on our door and ask for support.
And Florian, you talked about differentiation versus value add. How do you track over time? Do you track, and how do you track that value add? Is it some combination of quantitative and qualitative? And then I suppose, how would you see the weighting in terms of hands-on value add versus the differentiation that it provides to you guys as a fund? And do you think about that balance at all?
Yeah, that's a very good question, and we ask ourselves that actually internally also quite a number of times. Related to that question is also, what's the key thing here? Is it really about attracting the right founders with that model, or is it about making companies actually better? Ideally, so is it about winning deals, or is it about making the deals that we've already won better? And I think it's probably, although we are around now for 12 years, or in our 12th year, it's probably still a little bit too early to have the final say on that. So I think if you would have asked us in the beginning, and the idea in the beginning was really, we think we can fundamentally make companies better by supporting them and helping them. So it was really about the value add rather than the differentiation. My view has definitely become a lot more faceted here. So, and what I think you have to acknowledge is that you cannot turn a bad company into a great company by providing value add. But I think you can support an already good company that's on a good track. You can accelerate, and you can help them and make it better. So I would argue now that probably even the differentiation angle, I don't know whether it's become more important than the value add that we actually provide, or the value of that. But I think it has definitely, in our view, become a lot more important. Yeah, and it also, I think, helps us to self-select, or helps founders to self-select whether we are the right partner for them. Yeah, because I think we are a good partner for people that like, that are quite collaborative also on an operational level, that like to work with their investors on their company, because there are founders, and I'm not saying that's good or bad, but there are some founders that basically want to work on the basis that they know by far the most about their company, and they want to keep it that way because because they feel comfortable with it. Mm-hmm. And there are others that are very happy to share very openly a clear picture of where things do work and where things are not working so well. And I think those are the founders or the companies that I think we can work with best. Yeah, or we actually add something, or can add something if you have a very clear picture of where the weaknesses, where the strengths. People are very willing and open to share this with us. I think those are the constellations where I think the value add actually does kick in. Yeah, if you basically say we want to sort out the things ourselves as a company, which is a perfectly legitimate kind of statement, then you can obviously still take our money, but you will obviously not benefit so much from what we can provide. And I think that's what we also try to get across, or try to find out as part of a due diligence process. Do people like to get challenged also by their investors? Because obviously it's sometimes a little bit of a tricky position. How much do you want to open yourself to your investor? And I think I think the good thing about us is, or the good thing about us as investors, as we've seen so many companies from the inside, now at Project A, but also before, we know that even the best companies, they struggle operationally in certain areas all the time, and that's completely normal, and we acknowledge that. And I think, and there are some other investors that might basically say, "Oh, we always want our companies to look perfect from the outside, and we don't know about the problems they might have on the inside." And I think for us, it's different. So we acknowledge that even the best companies will struggle, and even the best companies will probably have 2-3 functional areas where they're really strong, but they might have others where they're not that strong because they don't have the thought leaders internally already that are driving those areas. And from our experience, it really is, you can you can compensate some of that over a certain period of time. But in the end, if you really want to become a substantial company that really is also operationally and business-wise successful in a sustainable and long-term way, they need to be excellent in 4, 5, 6 functional areas, more or less in a parallel kind of way. Yeah. So
Yeah.
and we are truly convinced of that, and we think that we can really help companies to excel in most of the relevant functional areas, and over the mid to long term. And we've seen very few companies that have not been excellent operationally, that are also sustainable successes economically or business-wise in the mid to long term. Yeah, I think that always has to go hand in hand, and I think that's also the true conviction of us here, and that's why we still think that this kind of model is also a substantial differentiation towards the founders that we work with.
Sure. And then just if you wouldn't mind explaining a little bit, because we've been looking at it from a K fund perspective in terms of how you structure venture partner relationships. And one of the things I think we've struggled to get our heads around is that long-term value alignment and long-term kind of commercial alignment, right? Where someone is spending some of their time working with something where they might be an operator in another business. And we found, for example, if someone wants to commit to being an LP and is in a period of their career where they have some extra time and some space, there's a really easy way to create long-term alignment between their ability to work with our companies and obviously they're taking part in K Fund. With over 100 experts, like how do you structure that? Is it done on a carry basis? Is it fee based? Like if you wouldn't mind giving an overview, I think it'd be fascinating.
Yeah, sure. I mean, it has to be and as you said, it's definitely a very complicated model to run. Just to give you a brief overview on also our thinking, and I think one elementary differentiation you have to make here is: are you looking for mentors for certain areas? Yeah, so like this mentoring type support. Yeah, that's often provided also by senior advisors or by venture partner type people from an operational background. So they are mentoring the CTO, they're mentoring the CPO, the CMO, whatever. Yeah. So and then you also have like the actual doing layer. So people that are operationally building a data warehouse or help to run the marketing function for some time, or are actually building applications as developers. And I think that the key thing to understand is that we have both. Yeah, the venture partner model or the operational partner model or the senior advisor model is often on the kind of mentoring type layer, which is perfectly fine. But I think you have to differentiate that from the actual doing, and we try to do both. Yeah, and if you look at also the operational value at companies like Andreessen or Insight, a lot of what they do is mentoring and maybe a little bit more, but that's where traditionally I think the operational value add is positioned, and we try to combine both. Yeah, we try to combine the mentoring and the actual doing. Although when we do something with a portfolio company, it's always a joint effort. So we would not work in an agency type mode where we work on a data warehouse, for example, and then pass it on to the company. It would always be a joint team of experts from us and from the venture. And we would not start to do any substantial work before there's at least one or two people within the venture that are also hopefully staying with that venture for the long term, before we start building on or anything that's substantial. So I think that's also important to understand. And on the incentive question is also a very interesting one. So all of the team leads and all of the people that are in leadership positions on the value add side are mainly carry incentivized. Or actually, technically, it's a little bit different. Yeah, but it works like a carry. So in fact, what we do is we pay their bonuses into a kind of virtual LP relationship that makes, tax-wise, that makes more sense. That's why we do it this way. So we treat them kind of as a mega LP, but basically the majority of their compensation, at least of the team lead type level, ideally comes from this kind of incentive. So they get a fixed salary, And the other thing that they receive is basically a performance incentive that's aligned with 100% with fund performance. And I think that's also the key thing, that you do that, because obviously you always run. If you look at how private equity funds do this, and I think that's also very interesting. Like KKR, for example, they run their own kind of consulting unit, which is called Capstone. Yeah, and Capstone is huge. Yeah, it's basically the mini McKinsey of KKR. And they charge also regular kind of consulting rates that then the portfolio companies will have to pay, and that's different with us. So the idea with us is we subsidize some of the costs of that operational team with a management fee from the funds. Yeah, so that's kind of the idea. And then some of it is also charged to the portfolio companies. But the idea is really charging as much as if an internal kind of employee would cost them doing a similar job. Yeah, but being a lot more flexible. And I think that's also a good thing incentive wise. Yeah, we want them to use our resources if they think it's feasible. But we also want them to build their own internal capabilities as quickly as possible. Yeah. So by charging a similar amount for a certain profile, as if it would cost to have that person in house, you incentivize obviously the portfolio company to really hire somebody for that position if they think it's relevant, and not replace a permanent position with somebody from us, because we obviously want them to build internal capabilities and want them to be incentivized to do that. I mean, sometimes it doesn't make sense to hire somebody full time. Like, for example, right now, if you're an early stage startup, you might not want to have somebody full time in house that's able to run, I don't know, machine learning type models or so. Yeah, that often is not necessary. So it sometimes makes sense to have somebody from us doing that for a couple of months or weeks, then handing it over to somebody internally from their data team that often is just 2 people or so, to continue developing the model. So it might make sense on certain competencies not to have it full-time in-house. But the general kind of incentive really should be to build in-house capabilities, and that's basically how we structure the model. So we don't have it as a profit-making exercise, and I think that's the key element here. That it's about covering cost, and about setting the right incentive for the startup to build those capabilities in-house. But it's not for us to make money. Yeah, the only way for us to make money is through the carry and through the success of the individual ventures, and how they hopefully produce exit proceeds. I mean, and everybody at Project A is incentivized to achieve just that, and not just run a consulting firm. And that's also why we basically, I mean, we have a lot of people. We have more than 100 people, but I think it's still important to note. I think if we would really run a full-time consultancy to do this, we could probably have double the people or even more, given the demand that we have from the portfolio. But it's not about having the maximum amount of people that you could possibly have in a kind of consulting type fashion on your payroll. But it's really about being able to provide value add, being able to provide a credible differentiation, being able to provide substantial support, but not about fulfilling every request or every demand from the portfolio. That's not possible. But really about providing more credible value add in that sense than most other people in the industry.
Super interesting. I mean, it's obviously like an investment function, not a cost function for you guys. And I guess, I mean, as you said, Florian, it's probably not going to do a 180 on a company. If a company is not going well, you're not going to turn it around with this. But if at the end of the day, if you can increase returns by 0.1, 0.2x, it's obviously worth it for you guys, I can imagine.
And where you can also sometimes see it, and I think it's making companies better, and also in moments of complete despair, you can also see it. Yeah. So if a company is in big crisis, you and people have left or whatever, you can keep a company alive and at least enable a decent transition of the company to somebody else. I mean, you won't make huge returns on that, but I think maintaining some of the substance that has been built. And I think that also has a non-monetary element to it that kind of makes you feel better about it. I think that's also one thing. But I think the key thing is really about differentiation, attracting the best deals, and making the best companies better.
I think this model ties in very well with your background, Philipp. Why don't you tell us a bit about yourself? How do you end up at Project A?
Sure. So I did a master's in media economics, which doesn't have to do much with what I'm doing today, apart from the fact that media is also non-haptic goods, right? So as is software. So that's probably, in hindsight, you can argue that there was some reason to that. And as a lot of people, I think I initially thought I'd go into consulting simply for the reason of being deployed in multiple companies, having a quick learning curve, etc. When I interviewed with these companies, I quickly realized that it's probably not the crowd that I see myself working with, but still wanted to work hands-on a bit more than consultants, and still want to work in a lot of different companies in a short amount of time, right? As opposed to working 2-3 years for one company. So I actively looked for opportunities to do that elsewhere in an ecosystem that would probably be a bit more, let's say I would have to wear suits less often. And back then there were really not many opportunities. There was the venture ecosystem was quite early, and I looked at Rocket, as Florian mentioned, who had an operational model, and Project A back then, which was only 2-3 years old. And luckily, I ended up at Project A in the said venture development function. So basically, I was one of the few generalists in this operational team, being the partner to founders, assessing where they would need or benefit from our support. And then basically I did that for some time, was lucky enough to then take over the leadership of that team. And at some point felt being a generalist is really cool and very, very helpful. And you probably know that feeling, you realize at some point, hey, do I really know something in depth? So I wanted to specialize a bit more. And then, there were some opportunities to take leadership of some other teams. So analytics for some time. And then I was our CMO, working with portfolio companies, CMOs for some time. And then eventually the partners thankfully offered me to transition over to the investment team, simply because being the operational VC, I think it makes sense to have operators or former operators in the investment team also. So I'm basically one of the few ones in the investment team that has background from within our own operational team, and hence having worked in and with a lot of portfolio companies.
Yeah. If you ended up at a consultancy firm, I mean, you wouldn't be allowed to do a podcast at 11 a.m. with a green cap. That's for sure. You will look a bit different. I'm sure about that. And by the time this airs, you guys would have announced this studio thing. Talking about differentiation, why don't you explain a bit more? And I think it would also help if you give like an overview about what kind of checks do you guys write, in what stages, and how does that tie into this studio thing that you guys have just launched?
Yeah, sure. Let me maybe give it a shot first, and then Florian can chip in. So in our regular deal flow ticket writing, I would say we're a seed fund. We mostly do seed. We occasionally do Series A's if we missed a company and really want to get in. We write initial tickets anywhere between 1 and 10 million. I think the sweet spot is between 3 and 6, maybe. And then I mentioned the 4 focus areas where we really specialize in terms of going very deep and building up hypotheses. So that's the normal deal flow. And then what we found ourselves doing more and more over the last years was spending time with founders at pre-seed. And coming from a place where you do seed, it's probably not as easy to then do pre-seeds, where you just bet on a team and a market, and you get to meet the team twice, maybe, when you're used to seeing some form of traction, right? So we thought, how can we do pre-seed, but give ourselves more time to get to know the team better? And how can we leverage our operational team and the expertise that we have in-house to do so. And effectively what happened was that we spent time with founders from our extended network that were already ideating, but hadn't decided yet what exactly the model or the idea would look like, and didn't go out to raise a pre-seed. So earlier than pre-seed, if you want. And we basically just engaged into sparring with them, talking about the spaces that they were looking into, giving them occasionally access to people on our end, for example, just from the network, to speak to corporates we're close with, to speak to experts we know from our deep dives, or to talk to our CTO about what an initial architecture would look like, etc. And we saw that that actually was very helpful to founders in ideation, because the alternatives they had were typically an accelerator or something very structured, right? Where they would have to join a cohort at a given point in time. Then they would be dragged through some form of program where they would be taught how to do a business plan, etc. And these people typically know that already. So they don't want these structured forms, these structured programs. So they, like, literally every single founder we talked to in the ideation phase was happy to be challenged by a VC, introduced to helpful people, be it operationally or just to validate the idea, without any obligations, right? And so we did this more and more. And then by doing so, we got to know the teams or the founders quite well, and ended up saying at the right point in time, hey, now that we know each other, why don't we do the pre-seed together? Because we know each other well. We de-risked you as a founding team. You de-risked us because you learned to see the value of what we offer, and then ended up doing the pre-seed. And basically, after having done that now for 16, 17 months, having invested into 7 companies like this, we launched the communications and called it the studio, which is basically just a word for this on purpose, unstructured collaboration with founders that are in the ideation phase.
And on that, do you think, because it's something we've definitely seen over the last few years proliferating more and more, right? In terms of, I think the US funds leading the way, as is often the case with scout programs, and then everyone kind of moving earlier and earlier. Is there an element of competition in there as well? Was that, I mean, it sounds like there was a kind of a bottom up there in the sense of a desire to go deeper and understand things better and leverage what you already have. Was there a kind of a top down or an outside in there as well of seeing those earlier deals getting snapped up more quickly, seeing funds moving kind of earlier up the value chain, or was it actually like an inwardly driven decision, 90% or more?
So I think it was both. It started probably top down, us saying that we would feel comfortable going a bit earlier and doing more pre-seeds. And obviously these can be very competitive, and you have to write fairly big checks without knowing the team well enough. And then bottom up, we basically figured out that there would be another model that is probably also quite unique to Project A, because we can leverage like the access to our 100 operators to be valuable to these founders early on. And that then really was more bottom up, just speaking to a lot of founders at pre-seed or earlier and hearing what they would deem helpful. So I think it was started top down, then we learned bottom up that how we have to shape this to be helpful. And now that we've done it a few times, and I think for the time being quite successfully so, future will tell, we thought now's the time to talk about it, because I think that's probably also like a bit the Project A way. We only talk about things when we know they work and we've done it a few times. So now we feel comfortable launching that publicly.
Sure. And I was looking earlier, so you guys have invested in, I think it's somewhere near 200 companies, right, over a 12-year period, with obviously some very big successes in there, and I'd imagine, as is always the case, a lot of failures and a lot of learnings. I'd love to understand a little bit your investment process of how you come to make decisions, maybe thinking about seed as your core, of how you make decisions to like how the IC works, how your deal flow process works, and maybe if that's changed, and if there are obvious ways that that's changed over the last 10, 12 years of your operations.
Maybe you start on how it works today, and I tell you how it worked in the beginning.
Yeah, okay, let's do that. So I think it's probably not too different from how a lot of other VCs that I know well work. The process is quite straightforward. It's essentially 4 steps. First one being a first call with a founder. If we really like it, we do a second one, If that goes very well, we typically try to meet the team in person. I think that's very important to us. And then the fourth one is our IC, after which we are decision ready. We do the ICs with the founders. So we have them sometimes pitch to us, sometimes it's more a conversation. And then we try to be in a position where we can take a very educated decision. So we try to keep it quite lean, and the personal interaction with the founders, ideally on the ground in person, is important to us.
On that point, Philipp, do you have specific ICs for these 4 core themes, or is it like the same IC for the 4 core themes?
No, it's always the same IC, which is basically all of our partners. And then we have a voting system that's anonymous. So basically, after the IC, every partner gets to fill out an anonymous questionnaire with a couple of questions: team, market, etc., impression. And then the crucial one is your indicative opinion on how you would decide whether we should invest or not. And that is basically 4 things. So yes, with strong conviction, supportive, a rather no, and a clear veto. Florian can chip in on how often we had vetoes in the past. I think the most common is that we have some partners having conviction, some being supportive, and if there's rather no's, then the discussion becomes more interesting, of course. And we have this rule that we need at least 2 partners having strong conviction to proceed with doing the deal.
How many partners are in the IC?
So all of our partners, ideally, if we can coordinate that, a minimum of 4 and 5 is always there, just to make sure that we can take a proper decision.
Okay.
But I think it's important to say it's not a majority vote. Yeah. So if 2 people basically say and I think that is a key thing also for early stage investing, or key element, that majority decisions, or even worse, like everybody agrees, is probably not the right mode to pick outliers or winners in early stage. I mean, obviously, if you have a late stage IC or private equity IC, I think majority votes can work. But I think if you want to pick outliers at the early stage, it's completely okay to disagree. Yeah, and the only reason that I can remember why we vetoed decisions is really on a personal level, where 1 or 2 people are, for whatever reason, think that that is a person because of the impression of the values of that person, or for any other reason we should
Found
not
the
invest.
references, I guess, as well.
Yeah, but that is ideally something that comes out before the IC, and I think that's also a key element. We have and that is a big difference to what we had in the beginning. We have a fairly structured framework now of a investment memo that we work into, so that the moment you go into the IC, if you've read the material, obviously, you're very well prepared to what the key questions are. So we force ourselves also to come up with hypotheses, what we have to believe in order to think that is a good investment. So we really try to make a lot of the work, including founder references, including customer references, before the actual IC, so that you can really, concentrate on getting a first-hand impression of the founders, and do you really think it's realistic that they can pull it off. But I think a lot of the conceptual work ideally has been done before, and we force ourselves also to put it into writing, and also following Jeff Bezos' logic also into like actual text, not slides. Yeah, so that you really have a disciplined kind of thinking process beforehand. And I think that's also the biggest difference to what we had before. So like when we started in 2012, it was more cowboy style, angel investing style type investing, and I think it became more and more rigorous and methodological. And it's definitely it's a good thing, and I think probably give you and one learning is also, and I think that's a key thing, to have anonymous kind of voting before is really something that we can recommend. So everybody can come up with their own opinion, irrespective of a discussion. Because what we experienced before is there's always people that have a strong opinion or that are more informed on certain ventures than on others, and they will dominate the decision, or they will dominate the discussion, and therefore also the decision. But the moment you have, people anonymously vote, or voting on how do they like the team, how do they think the defendability is, how do we think the exit market is, and everybody does that based on their own impression and their own kind of reading of the memo and the facts. You have a lot more structured and informed discussions based on that. Yeah, because you see, oh, we obviously disagree on the team. Why is that? And then go into detail here. And I think that has really helped the quality of our decision making and the quality of our discussions, to have this voting up front, and then have the discussions guided by that.
And maybe quickly double clicking on the rationale for having these 2 conviction votes that we require. I think part of the idea is that the partner who brings the deal into the IC upholds their conviction, right? So that after the IC, they are still very strongly in favor of doing the deal, which is probably likely if the team performs well. But the other conviction is also meant to be a testament for the team being very strong, right? So there is an element of the partners obviously having read the memo, being on board to some extent, but not the experts for the deep dive, maybe. Having such a strong impression of the IC that they feel comfortable voting with conviction also. So you have these 2 tests. Does the partner who brought the deal still uphold the conviction? And was the team able to convince someone else that only has context provided as by the memo?
Mm-hmm. And on that topic, what does the memo look like? Is it, you mentioned Florian, Jeff Bezos. Is it like a 6-pager? Is it like a 50-pager that not a lot of people end up reading? What does it look like, as far as you can share?
Yeah, maybe I give it a go, because I wrote a couple of them.
More than me, at least. Yeah, that's true.
So typically, before the memo, there's always a debrief that gets sent around earlier, when we were in the first calls with the team. So the memo doesn't basically come out of nowhere. There's typically some context already. What a memo then does is typically somewhere between, I would say, 10 and 15 pages long. And it covers all the areas that we think are crucial to assess a deal. And they are probably not very surprising. So at Seed, that's mostly getting hypotheses on how the market will develop, of course, but then a big section on the team and how we perceive them in our interactions, the references, etc. And then obviously how the company is performing metrics-wise, as long as there's something to analyze, which typically at Seed there is, and less so in the studio cases. So that's all, I think, quite straightforward. What's important to us is that there's also a section on how big can this become, because we found ourselves looking at the risks quite a lot, but it's easy to forget about the target at hand and the price you want to win, right? So with a fund our size, we have to be quite disciplined in terms of how big can this become, because this could be an interesting company, but is it going to be big enough for us to make the returns that we want to? So that's a section that you will probably not find in every other memo out there, but that is quite relevant to us.
Don't you feel like that's, I mean, that's obviously a key question, but we feel like that's sometimes very subjective. I mean, measuring the upside, how big can this be? Or how do you guys think about that?
I mean, there's a quantitative approach, right, which is really more like the market sizing. I think that has to be a part of it. And the other part is, like, you could call it a bit of fantasy, but like, how will this play out if this becomes a success? Forces you to think more about the positives of the company, while a lot of the other things are making sure that we eradicate some of the risks, right? So I think this qualitative, having built a strong thesis on this space that is backed up also by expert calls, etc., and how this will evolve over time, yes, that's very subjective, but it's ideally informed by the research this person has done, and not only on the specific deal, but by really spending a lot of time in that very deep dive, right? So it's exactly what we want, this subjective opinion by the person
Hmm.
that on our team is probably best equipped to share that subjective opinion.
And I think forcing yourself to think this through and having some hypothesis on that obviously can be refuted afterwards. Yeah. So, but I think that's I think the whole beauty of this process. You force yourself to come up with something, and then you can also revisit it. And I think that's also a learning for us. I think if you have the decision on follow-on investments, going back to the original memo and see how things have evolved, that has really helped us, I think, to form an educated view on this, and also draw learnings. But you're right. I mean, especially if you have a company where you think that requires some kind of behavior change in the market, because it introduces a new category of software. It's obviously very hard to do some kind of quantitative TAM analysis or whatever, because obviously the TAM will only develop if they are successful in a certain way. But you can at least try to triangulate it a little bit by saying, okay, how big is the problem? What's that this company is solving potentially, if this turns out to be right, and what could develop out of this. Yeah. So then you probably won't put it into some kind of definitive TAM number, but you would at least say, okay, do we think that from that kind of, or solving that kind of problem, a substantial market might develop or might arise, and then that's one hypothesis. Yeah, obviously, especially on follow-on investments, like 18 months later, or 14 more 15 months later, and now it's typically more 18 months later. Yeah, with times not being so crazy anymore. It's definitely something where you should have a more informed opinion on than with the original investment, at least. Yeah.
Yeah, I think it was Mark Andreessen who had this phrase in a talk that said when they invested at seed, they would invest in strength, not in lack of weakness. And I think sometimes we had even our K fund, especially at seed stage, we have to remind ourselves about what you were saying, Philip, about not looking at all of the risks, because there's always going to be a ton, but just focusing on the upside. Yeah.
I'm obviously not as eloquent as Mark Andreessen and putting it that well, but that's the gist of what I was trying to bring across.
That's right. And one element that's probably also interesting here, and I think I wanted to point that out as well, because Philip basically said, there's one partner obviously bringing a deal to IC. Yeah, one special thing about Project A is probably also not only because you are the partner bringing a deal to IC, you'll not necessarily be the partner that's also responsible from the partnership dealing with that venture. I think that's a key thing about Project A. So you can be a partner bringing something to IC, but another partner might be the one responsible for that deal later on. Yeah, because we always try to see this as a team effort and basically try to understand who might be the best partner given their background, their expertise, to be kind of the key account manager from the partnership for that specific venture. And I think that's also different from what other funds do. And I think in a positive way different. So in the end, the founding team will always have the last say. If they want to work with a certain partner, and that's the partner that brought the deal to the IC, we will accommodate that. Yeah, because in the end, it's always founders first. It's like our first Project A value. So if that's a preference, that's what they're getting. But if they are flexible in a way, we always try to think about who's the best partner going forward, and that might also change. Yeah, so we've so for example, some partners that are better in the earlier stages, finding product market fits or supporting that process, supporting on the early company building, and others of us are more structured, more financially focused, more rigorous in a way, and that personality sometimes also fits better for later stage companies. Yeah, and the kind of board discussions you have at a later stage.
Yeah, maybe just one thought, because we oversimplified, of course, by saying a partner brings a deal to IC. I think it's very important that we're super collaborative. So it's mostly deal teams working together, and that can be two partners, for example, right? So there's a lot of companies we see at the intersection of the deep dives that I mentioned. And then we partner up. So we, for example, if I'm looking at a B2B marketplace and there's a strong fintech component already, then I would look at that together with our partner from financial infrastructure, and maybe also team up the associates supporting on the deal, right? So we're very collaborative, and I think very little elbowy. So also in terms of sourcing, etc., we always try to give the founders the best counterpart on our end that really understands their space the best. I think that's also not a given in all other funds. So I think it's worth stressing that I think we really try to do everything very much as a team effort.
Florian, you brought up the topic of follow-on rounds. So we discussed how you guys make investment decisions, but we, at least at K Fund, sometimes we feel like the follow-ons are the most important and the trickiest. So how do you guys deal with those?
Yeah, I mean, first of all, given also the fund size that we have, and also the early stage nature of the initial investment, it's
the fund size is 330, something like that.
Yeah, it's basically the venture part side of things is 275 in the current fund, so around 300, and so. By the nature of the fund size, it has to be in a way, or has to be structured in a way that the majority of the money that we deploy will come in follow-on rounds. Yeah, so I mean, we typically have like 32 to 35 companies probably in the fund. If you have the studio that we talked about earlier, studio deals, it might get close to 40. But still, I mean, if you take the average initial ticket, it's quite clear that 2/3 or even more of the money will go into follow rounds. So obviously it's essential to think about that process. And typically we are the lead investor or one of the lead investors in a pre-seed deal, on also Series A deals. So we're one of the larger investors, and typically we try to be supportive in a way that if we do an initial ticket and if nothing crazy, strange, or really, really unexpected happens, we would typically do our pro rata for the next 1-2 rounds at least. Yeah, so that founders can expect, I think, from us, and we're quite, I would say, stress resistant and resilient. So it's not about like meeting a plan 100%. It's really about are we still on a track to build something along the lines of what we initially wanted to invest in. I would say we are well over 90% of the companies that we invest in. We typically also do or participate in the follow-on rounds with our pro rata or even more. But in terms of process, it works quite similar, yeah, to the initial investments. So also then we would not expect a 10 to 15 page memo always, but at least an update on the original memo and an opinion of the key account partner that's shared well before the actual decision, and again an IC decision. Yeah. Whether we would participate in the follow-on round or not, and again, it usually requires an IC decision with also the founding team or the management team, doing another presentation and another Q&A with us. So we don't see that much different than from the initial kind of the process-wise from the initial investment, but typically at least for the next 1-2 rounds after the initial investment, we continue to invest. And we can do up to technically we could do up to 10% of the fund in one company. We tend to be around 7 to 8, up to max of 7 to 8%, 7.5 to 8% of the fund in one company. That's typically the max that we would do. Also, kind of in discussion with our main LPs in order to avoid a too strong concentration on one specific asset. But what we typically also are able to draw on if we require more money is opportunity vehicles and SPVs. So I mean, there are companies where we've, for example, one company, the maximum we could have invested from Fund 3 in that case would have been 15 million. So we invested 15, and we put in another 45 from SPVs and opportunity funds. So we can typically activate a lot more money if we need to on certain deals, but that would not come from the main fund then, but from specific like asset specific SPVs or opportunity funds in that sense. And that's also our strategy. So we don't have a dedicated growth fund or things. We have one main fund, and then we would add pockets if we are able to that are dedicated to specific deals or a group of assets. Yeah.
Sure. Very, very interesting. And guys, I think we've touched on it previously, but talk to us about thesis. So you have the four pillars at the moment. You mentioned that you've moved away from consumer, which I presume, well, it was something that was a much bigger part, especially of the German ecosystem 5, 7, 8 years ago, right? A couple of questions, I think, stemming from that. How do you think about these pillars, how they develop over time, how they change, and potentially you move away from one and add in others? And then connected to that, how do you stop yourselves being driven by trends, right? The Web3s, the metaverses. I think even climate at the moment, there's a lot of trend-driven activity. Like, how do you think about that whole thesis-driven approach?
Yeah, maybe me starting, and then Florian, you can say a few words on how we prevented ourselves from participating in crypto, etc. So the thesis-driven approach really comes from, as I mentioned earlier, wanting to have a clear edge while being a generalist seed fund. In that we're capable of talking to a founder about their space on another level that other investors maybe would be capable of doing, because we spend a lot of time in that very deep dive and building opinions. And these deep dives obviously change over time. The four I mentioned are the ones that we are excited by now, and they might not be the same in a year's time. We also have one investment manager focused on emerging categories, as we call it. So basically trying to find the next deep dive where we want to spend more time. And this, I think, has historically grown a little bit. So we had deep dives. We always had deep dives in the investment team, but then every investment manager started having multiple of these, and then it got diluted a little bit, such that it basically turned into general coverage, and we knew who to talk to for what topic. And we more recently disciplined ourselves more and saying, hey, we don't want to have just general coverage. We really want to be experts in certain fields. So those are the ones that our deep dive owners are excited by, and where we have the thesis that they're so big and there's underlying economic trends at play that make it so that it's a space worth spending time on, right? And I think that the ones that I mentioned are probably not super surprising. Climate and energy, I think, is an obvious one because of what's happening on a global level. Supply chains, the same. I think European resilience also, probably in light of the last 2 years. And then financial infrastructure is probably a bit less obvious, although a lot of VCs are spending time on this just because it's huge. But we also have a specific track record in that space with companies like Trade Republic, Liquid, Recap, Zaps, that I think we have a lot of knowledge on that space in-house. So it would be stupid to probably not continue that deep dive, right? So they're always evolving, but these are the four ones we're looking at right now.
And then on that, I think one of the things we've spoken about previously is climate. And the more I get into this space, the more fascinating I find it, but also in many ways the more frustrating, in the sense that from a venture perspective, it's a lot of stuff that doesn't fit hockey stick growth software businesses, right? Like, you've got weird business models, you've got first of a kind technologies, you've got a hardware component. And my personal take at the moment is I think climate needs a ton more infrastructure, and there are a lot fewer people trying to solve home energy management businesses, but it's really difficult, really difficult area to get your head around. in unproven markets, and then from most of the stuff we're seeing is basically selling into the same kind of customer types: big financial institutions, big energy companies, big construction companies, who are hard to sell to. It's enterprise software at the end of the day, but and getting those contract sizes that lead to venture scale returns is really difficult. And I was looking at your recent investment in Montamo, the heat pump installation training play, right? And I've been looking at similar stuff in Southern Europe and LATAM on this. And I'd love to just ask how you guys feel about, because I don't think it's a sector climate, right? It's a mega trend. It's almost like an approach in many ways. But how you feel about investing in climate at the moment, how excited you are about the businesses you're seeing, and whether you feel like it's ready yet in many ways, because I love it and I care about it, but I have a lot of doubts at the moment.
Can I go? Maybe if I might chime in here, because I think it ties to some of the stuff that also prevented us from being extremely momentum driven in the past. Yeah, because you're 1% right, 1% right, Max. I think one should not forget, and I think that's often the hardest differentiation. It's not just about a trend supporting something. It's also very much about the fundamental business characteristics that make a business not only a good business or bad business, but also a business suitable for venture.
Yep.
And I think I would agree with you that a lot of the businesses that are very useful and that can also be great businesses are probably not, perfectly suitable for digital venture focused VCs that have a 10 to 12 year timeline, that need progress every 12 to 24 months, that have one investor as seed investor and ideally another one for a series A or B or whatever. Yeah. So I think especially the very hardware focused stuff, the very research focused stuff, probably needs 15 to 20 year time durations, probably needs institutions or people or whoever the investor might be that can do 5 year of runway, because it requires some research. And I think you have to be quite disciplined here. As a digitally designed venture fund, whether you're really the suitable source of capital for those businesses. And I think that is probably apart from, the 4 deep dives that we have, we kind of as a metrics criterion. If you think about it, what are just things that you have to see in a business that really make it venture suitable? And that's often not a very clear cut decision. I mean, to because I mean, businesses can also be in the offline world. For example, franchise businesses can sometimes be venture businesses, because they scale well, although they are predominantly in the physical world. But very often, as you said, scalability is the case when you have network effects, when the value creation happens at least to a high degree in the software world or in the data world, and that's probably not always the case for climate, despite that being great businesses. So I think we always have that filter as well. And I think the time 2020 and 2021 painfully reminded us, that not all businesses that are great businesses and that scale fast are also venture businesses. That capital efficiency is also a key element in especially when it comes to things probably not developing as fast as you originally thought. And I think if you look at what SoftBank did and Core2 and Tiger Global, I think a lot of it really shows how not adhering to those kind of basic principles also doesn't lead anywhere that's feasible or sensible in the venture space. So we always try to keep that in the back of our head, and look at the business also through that kind of lens, whether we are really the best source of capital for a given fund. I mean, that's also the case, for example, for many direct to consumer businesses that can be great businesses and that have a justification to exist, but they're not in essence venture businesses that should take on tens of millions of dollars, but probably just require 1, 2, 3 more million from an angel investor consortium or family office, and they're much better off just restricting themselves to that kind of money than going down the venture route. And I think that's what we always, and that's also part of the IC discussion quite often. If you have businesses like that, or even beforehand, before bringing that business even to IC, trying to assess the venture kind of characteristic of those kind of businesses. Sorry, it was a little bit of a lengthy answer, but I hope it gave a little bit clearer picture of how we think about this.
And Max, because you mentioned energy and climate specifically, so I'm constantly somewhere between incredibly excited by what great founders we see there, and as disappointed that it's hard to find models that are really venture suited.
Yeah.
So I spend a lot of time specifically on energy over the last 2 years, and there were very few companies that I wanted to back, and even very few ones that have what Florian just called the structural components to the business that make it so that they even would benefit from taking VC money on. So it's really cool to see how many smart and brilliant people are building in the space. But for some of the reasons that you mentioned, I think it's difficult to find many potential VC outcomes there. And because you mentioned Montamo specifically, which is funnily one of the studio companies, I think the thesis here, and you're probably alluding to it because it's a fairly operational business, right? So what they do is they try to solve the bottleneck of heat pump installation capacity. And they do so by upskilling a lot of, let's say, blue-collar people to how you install these heat pumps. And it, at first sight, might not sound like a VC case. But if you think this through and what economic drivers are at play here in terms of labor shortage, in terms of the number of heat pumps we need to install in such a short amount of time, and then if you think through how this model could scale, which is in the long run likely via franchise, etc., then actually we came to the conviction that this is a model within the larger energy space that could become such an outlier. And obviously that's debatable on all different specific cases, but it's one of the few ones because I agree with you that there's a lot of like home energy management. SaaS is probably the most obvious one. That is just going to be commoditized, in my personal opinion, without going too deep into energy now. But and these insights then lead to us also deprioritizing certain deep dives that we spend a lot of time on. For example, we did spend a lot of time in digital health for a long time, and we backed a very successful company called out of Sweden there. But then for a long time, we didn't find other assets where we were really positive they would yield the right outcomes. And then we basically deprioritized this and moved on. That's not to say that we're not going to do a deal there, and we still have expertise there, but we're spending less time on a space if we came to these conclusions.
And then just very quickly before I hand over to Heinemann, who I know has something he wants to ask, are there any areas in the climate space that you are particularly excited about at the moment?
Yeah, then I think you're asking the wrong partner on our end because, as mentioned earlier, we always have a champion for a deep dive, and that's our colleague Mila in that case. So I would have to defer you to her. But obviously, there are some cases that I think are not surprising, and then others, as that Florian alluded to, where we think they will need some hardware involvement, are probably the ones that are less interesting to us. But yeah, can't go much deeper on that because I'm very focused on my own deep dive.
No worries.
I wanted to ask you guys about the EU European resiliency part. Can you talk a bit about why EU resiliency, any investments that perhaps you can disclose in that area?
Florian, do you want to take it or should I?
Yeah, I mean, we have one of our partners, Uwe Osman. He's also one of the founding GPs, and he has a pretty he always looked at deep tech stuff for quite some time, and I think he was one of the earliest also in the VC scene to recognize that with the events in Ukraine, but as I think also beforehand, that technology supporting European resilience definitely is it's necessary, and sensible, but it's also from a VC perspective probably an interesting angle to invest in. And so one of that is obviously defense tech, dual use type technology. But it can also, we've invested in one company called Black Semiconductor that tries to, come up with a new way to design semiconductors, obviously. And that's also part of European resilience. And but I think most prominently, we've invested, for example, one company called Quantum Systems that has developed surveillance drones from a hardware perspective, but also very much so from a software perspective. That are an integral part now, for example, also of the efforts that happen in Ukraine, obviously on the Ukrainian side, not on the Russian side, and that will also, looks like it will play an essential part also for other European armies and Western armies going along with that in building their drone capabilities, especially on the surveillance side, and that can obviously be a very interesting business. That's also very scalable, but it's also something that definitely has a positive impact on Europe, or is something that we probably recognize more and more as societies, that will be essential to that we have our own capabilities and companies standing for those capabilities in Europe, and not just rely on American technology in that sense. And I think Uwe recognized that quite early. And together now with Jack, who's a principal in the London office, is driving that forward. And we've done a couple of investments there, and definitely will continue to look at companies in that space, and I think it's a very good example of a deep dive kind of selection, because we think that this will be a mega trend, or this will be a development that we see for at least 5 to 10 years going forward, if not longer, because I think a lot of the developments that we see, or the requirements that pop out of these developments, are things that we have to solve in the long term, that are not that easy to solve, that are hard problems, and just take time. And I think that's a perfect example of how we choose, and also how deep dives evolve and develop over time. And here we have two people covering this, and I would say it's a fair hypothesis that like 10 to 25% of the current fund, and maybe also the next fund, will go into companies representing this kind of deep dive.
Interesting. And then maybe just pulling it back to the mechanics of venture a little bit more. I'd love to chat about fundraising and liquidity. So I was looking it up. Your first fund in 2012 was an 80 million fund, right? And your most recent 2022 fund was 335 million. Presuming the approach, obviously ticket sizes will have changed with that, but presuming the approach hasn't changed massively, how do you think about it in terms of liquidity for LPs? How do you think about success? And is the job you're doing harder now than it was back then, that you're dealing with much larger amounts of money that are, in theory, harder to return?
I think, yeah. I mean, obviously, that's. I don't know whether it's. I mean, right now it's definitely harder. Yeah. So in 2023, 2024, but I think the ecosystem has also evolved quite a lot in several senses. That I think a lot more of the companies that we see today have a global ambition. Yeah. So. And I think the big difference in 2006, 2007, and also at the beginning of Project A, especially the consumer companies that we saw, had a German ambition and maybe a European ambition, but it was obviously quite hard to scale beyond that, at least so easily. And I think the thinking in the B2B space and the thinking in the software space, or more software-driven companies, is often probably not global from the beginning in terms of the scope of customers that they try to serve, but at least the ambition level in a lot of these founders and founding teams is global. And I think ideally, if you're successful and if you have a hit, or an outlier type company that's performing really, really well, it's also more realistic that there is not a European buyer or a German buyer buying it, or that the company will do an IPO at Frankfurt, but that those companies actually could also theoretically list at Nasdaq or can be bought by an American software company, and I think a lot more of the companies that we invest in today have the theoretical possibility or optionality of addressing a global exit market. So and that's obviously a lot larger than what we had at the beginning. So I wouldn't say that it has become necessarily a lot more difficult. I mean, the current years aside, yeah, I mean the current years are obviously, regardless of how big your fund is and regardless of where you're based, I think creating liquidity right now is just tremendously hard, especially if you want to do it at decent valuations. But I think we all know, or people that have been in the venture industry for quite some time, or in any industry for quite some time, know that there's always cycles, and right now we're probably at a quite bad time in the cycle. Will we return to 2021 craziness? Hopefully not. Yeah, but I think if you have a decent software company that has also an American set of customers, it was also realistic to sell it to an American buyer in 2019 or 2018, and I think that will return. And we just try to focus on supporting companies to build a great business that's ideally not too Europe focused, but also covers other geographies, because that obviously allows them to also address other exit markets and obviously address other markets in terms of growing. And I think what you have to acknowledge if you're an early stage investor, different than private equity, it's just harder to plan exits. There's always windows that you have to use. The next window will definitely come. I mean, it's quite hard to say right now whether it will be start at the second half of this year, next year, or 2026. I think that's very hard to predict that. But what's clear is that the tides will turn into a more positive sentiment, and then also exit markets will return, and then there will be a window that you have to use. But as anybody knows that has been investing in early stage venture for quite some time, fund durations can easily go above the 12 years. Yeah, that most funds are designed. I mean, there's very successful funds that rather take 15, 16 years of duration until they really return all of the capital that's in there to the investors. I think what's also noticeable, and I think that's also something that's great, and I think that will also return to a much stronger degree in what we saw already in 2021 and 2020, were like secondary opportunities will definitely become more available. I mean, they are available also right now for early stage funds, but obviously at huge discounts. But those will definitely, those discounts will definitely recover to more realistic levels once people have really found a common or more common ground on what fair valuations are for tech businesses. So if you look at the private equity markets, and instruments like continuation funds and the whole instruments around the secondary kind of opportunities that you have there, I would have the hypothesis that a lot of what you see there in those markets, to some degree, that to a little bit of weaker degree than what you see in a classic private equity markets, but definitely some of the instruments that you see there that are very prevalent there. I mean, the secondary market in private equity is larger than the primary market, and I'm pretty sure that we'll see a similar development in the European VC ecosystem going forward, and that will obviously also make it a lot easier to create liquidity if you need to. And I think that's one key element to also develop the whole ecosystem further, and makes more people invest in venture. If you have the optionality, or if you have the option on and the instruments and the toolbox to create liquidity on a more regular and more foreseeable basis going forward. Yeah.
Yeah, on fund duration, in our previous episode that we had Stefan and Peter from Creandum, they openly discussed about this, and they said something along the lines that the fund, so the Spotify and I Settle fund, which I think is from 2007. I mean, they were closing when we recorded, so 6 months ago to a year ago. They were still now closing that fund, so 17 years later, and they did this analysis on returns. And obviously, when it comes to year 10, 12, 13, I mean, you start to get pressure from LPs about selling and providing liquidity. And that fund was going to provide 13x now that they were closing, so 1.3. And they did the analysis of looking back at returns that they would have gotten if they had sold at year 12 or 13, and that would have probably been like a 3 to 4x fund. So by extending 4 more years, they were able to produce like amazing returns. And on this topic, Florian,
but you have to give the LPs the optionality, and I think that's the thing. Yeah, I mean, there might be people that are not so liquidity focused that basically say, I want to maximize returns. And I think that's why I like instruments like, for example, continuation funds so much, because they give LPs the optionality to sell at 4x if they're happy with it. Yeah, exactly. But if you can wait, like a lot of family offices obviously can wait sometimes because, for them, it's the excess kind of cash and it's a small part of their allocation. And for them, maximizing returns. And also, if you look at a lot of endowment funds, how they use venture, they use it as an instrument to provide upside, like a strong upside. And the liquidity needs that they have, they service with instruments that are a lot more predictable. So they're completely fine with waiting 16 years. If the IRR is 35%, that's completely fine with them. And I think that's where I think the private equity industry, like in the sense, I know venture is part of private equity, but in private equity, I mean like buyout and where they are just a lot more advanced than we are in terms of providing optionality to LPs. And I think that is something that we as an industry have to develop as well, so that, people that are fine with the 4x, and I think that's perfectly fine to do that, and rather want to sell 3 years earlier, that they can actually do that. And hopefully in the next wave, in the next upside cycle that we see, this development of a more sophisticated toolbox will continue. And because I think that's a key thing or key element to also channel more money into the venture ecosystem if we're able to successfully do that.
Yeah. To wrap up, Florian, Philipp talked a bit about his background, but I would like for you to do like a 1 minute. And I know you had a long career, so perhaps like 1 minute is too short, but like 1 or 2 minute.
15 minute.
15-minute story of yours. And I would like to tie that into, I mean, what motivates you these days? Why continue to do this? And also, how, as one of the founding partners of Project A, how do you think about legacy? How do you think about when to bring up new guys, where to find those guys, whether you promote them internally, whether you try to find partners outside of the firm? So what's the main motivation of still doing this?
That's also part of the 2 minutes?
Yes. When you no. That's the 2 minutes is just the introduction, but you probably don't need to do this anymore. So why continue to do this, and how do you think about the legacy of Project A?
Yeah. I mean, first of all, how I got into this, basically by accident, was the first wave of internet kind of companies in Germany in 1999. I was 23, coming right out of university, didn't have a family, not even a girlfriend. So I thought, okay, nobody I have to, take care of. And so I founded one, an internet startup basically in 1999. So I never had a proper job, basically, in any kind of real company. But right, went into this ecosystem, specialized a lot on like digital marketing and back then it wasn't called business intelligence or data. It was rather called, web analytics or something. So those were kind of my operating things I focused on, and that drove basically my whole career afterwards. So I founded this first startup, had a decent exit, started angel investing in 2006, and did close to 100 angel investments over like a period of 2006 to 2015. Had a brief stint at university to do my PhD, 2002 to 2004, when not much happened in European venture, but then basically returned to the venture scene. Was at Rocket Internet for 4.5 years as a managing director, focusing a lot also on this operational expertise of mine. Continued to do angel investing, and then after 4.5 years with Rocket, co-founded Project A together with 3 other partners. And that was basically my career. But always, at the intersection of investing, angel investing, and this operational kind of focus on performance marketing or digital marketing and business intelligence. Now I'm obviously a lot more focused on building in an investment company as a company building kind of exercise than actually doing the operational work in performance marketing. But it's still kind of my heritage, and it helps me a lot, I think, to support founders, and it really informs my thinking. That's more probably bottom up than top down when it comes to investments. Yeah, so that's why I'm also still believe very strongly in operationally well run companies, and that's just my focus until today. And when it comes to motivation, I mean, what I found out over time, I think. I think I'm an okay to mediocre entrepreneur, yeah, but I'm probably a pretty good sparring partner and mentor, and I enjoy that a lot more. Yeah, so I think I found out over time I'd rather support people doing a better job than doing the job myself. Also because I found out that I'm probably better at doing this than doing it myself. And I also found out for myself that I immensely enjoy when I see that people succeed with a little bit of help from my end here and there. Yeah. So and and that's not only restricted to entrepreneurs, but there's also when it comes to seeing your children and things. So I really just enjoy pinpointing people in right directions and giving hints that obviously don't make their career or not make their success, but at least we have a feeling that contributes a little bit here and there. And I really enjoy that, and that's really what motivates me. In essence, and for me, it's always the greatest joy if I look back at a company that we met early stage, or a founding team that we met early stage, and then 10 years later they're super successful and have built this great stuff, and they don't need my advice anymore. They probably cannot even remember it anymore, but it's completely fine, and that really what drives me and motivates me, and until today. And I wouldn't know anything else that I would rather do, to be honest, until today. Obviously, topics change, type of people change, but it's the motivation kind of is quite constant, and as long as I can keep doing that, I will. Yeah, but I think what's really essential when it comes to legacy. I think what venture has struggled with, and we intend very firmly not to struggle with that, is a generational handover. Yeah, so that that we will definitely have some kind of maximum age here at Project A. We haven't fully agreed on whether it's going to be 61 or 59 or 57 or whatever. But I think one clear learning, if you look at firms, whether it's McKinsey or BCG or any type of successful firm over generations in a service kind of area, there needs to be a very clear way of how people move into responsibility and ownership, but also how people move out of it. Yeah, and I think our promise here to people starting in the investment team now, or being younger partners, is that it's 100% clear that you will own this company, if you stay on, sooner or later. I think McKinsey also, they do a very good job. They fade out people, I think, at 57 or 59. They can still stick around, call themselves senior advisor or whatever, yeah, and still have an email address, but they don't have anything to say in the firm. And I think that needs to be 100% clear that is the case. And I know people struggle with that. And I even know some fund of funds that say we only invest in venture firms that have managed to do one generational handover. And I think that's a very smart way of looking at things, because if you have the time horizons we just talked about, yeah, 15 years. I mean, I'm now 48, but I'm now 48. But if you start a fund now, I would be 63 when a fund like that finishes. Yeah, and I think that has to be kept in mind. And I think early stage investing, I'm not saying that old people cannot do early stage investing, but I think you always have to make sure that you have enough influence of the next generation in decision making, in finding companies, and also in working with entrepreneurs. Yeah, so I think that's a key thing, and that's what we want to make sure that this happens. So there definitely be a handover to the next generation. That's going to be structured, and it's going to be very clear how that works. And in terms of promoting, we try to be quite internally focused on promoting, and I think that's also one clear learning from the McKinseys, the Goldmans, etc. There are people they hire from the outside, but that should be an exception for good reasons. I mean, you can always do that, but I think the predominant path for promotion has to be internal. And whether it comes from the operating side in our case, or the operating team, or the investment team, I think that's a secondary consideration. I think it should ideally be from both. But I think one clear learning, I think, from all major consulting firms, etc., is having this culture fit and having developed this identity over time for a firm. That's a key element of being successful. And I think you can only guarantee that if people rise kind of internally. So there should be a strong preference on internal promotion, I would argue.
Yeah. Last two closing questions to each of you. Can you recommend us a book or some other form of content? And can you also suggest someone to invite to the podcast that hasn't been on before?
I can start. I always struggle with this question. Can I recommend one book or one source of content? I think what has worked best for me is a combination of sources. And that's especially in venture. I think there's a lot of smart people writing very good newsletters. So what worked for me is finding my top 5, top 6 newsletters that I consistently read, and they're long reads. And I really save them for the weekend and then go through them in depth. And there's a few to name, but I think it's really depending on what sectors you're interested in. So I can highly recommend doing the research once, talking to people that cover the same space that you're interested in, and learn from them what the newsletters are. So I don't want to recommend a specific one, but there are very many out there. I can recommend, however, a specific person that you should probably have on the podcast. I'm curious to hear who Florian will nominate, but I would suggest to invite Andy Helbig from Atomico. We used to work with him quite closely because he was at Project A before, did a tremendous job here, and at some point decided that he wants to work in the London ecosystem and joined Atomico, now a partner there. So I think he's a very interesting person to have this chat with, because he can probably confirm and some of the things we said. You can also ask him what was not right. And he has a very specific, different approach, covering specifically the Nordics in quite some depth. So very smart guy, very likable guy. I recommend that you have him on the show.
Fantastic.
Florian?
Yeah, I would recommend. I'm not a big reader in the sense, at least not for the stuff I enjoy so much. So I like to listen to podcasts a lot. And one podcast I truly enjoy, because it's something that always brings you to new kind of thoughts and lets you like have a look into new areas is a podcast called The Knowledge Project. Yeah, they always bring on experts from fields you've never heard about. And so I enjoy that a lot. And what's actually also quite cool is Lex Friedman. Actually,
Yep.
I don't like Lex so much, to be honest, but he has impressive guests. It's just crazy the kind of people that are on this podcast. I think if Lex would be a better interviewer, it would even be better. But the guests that he has, like from Benjamin Netanyahu over Mark Zuckerberg and Elon Musk or whatever. So he has just a crazy roster of people coming to the podcast. But the Knowledge Project and then probably Lex Friedman is if you don't know it, you should definitely have a look into it. In terms of people, I would recommend, or one person. What I find a really interesting story, and he's been around also for quite some time, and he's probably been one of the pioneers of microfunds, although they're not so micro anymore, is Philipp Möhring from Tiny VC. He's a great guy, very thoughtful guy. Thinks about VC also holistically a lot, and I think they've done a lot of smart things. So I think having his thinking a little more decoded, it would probably also be very interesting to your listeners.
I've asked him several times, but eventually
he doesn't want to come.
Well, he said, I think I asked him like 6 months ago or a year ago. He said, once we do the fundraising for the new fund, I'll come on. So I'll definitely ping him. Okay. I think he just moved to San Francisco for 2 months, but we'll have him on.
Yeah, that's true. That's true. He moved with his family. That's true. Yeah,
exactly. Yeah. Florian, Philipp, this has been great. So thanks a ton for your time.
Thank you, guys, for having us. It was a pleasure.
Thanks a lot.